If you are looking at the market and telling yourself everything is probably fine because the index still looks healthy, I think you are staring at the wrong part of the harbor. When a harbor is losing water, the boats do not panic immediately. For a while they still float. The paint still shines. The lights still reflect on the surface. People still walk the docks and talk as if nothing has changed. But the depth is going. The depth is what matters. And once enough water is gone, the weak hulls do not gently settle. They hit the mud all at once. That is how I want you to think about liquidity. Not as an abstract policy word, not as some technical line buried on page 7 of a macro report, as water under the market, as the invisible depth that lets expensive assets keep pretending they deserve the height at which they trade. Most investors do not study the water. They study the boats. They look at the SP, they look at the NASDAQ, they look at the 1 or 2 stocks they own and ask whether the price still looks respectable. That is how people get trapped. Because the moment of danger in a liquidity cycle is not when the headlines finally admit something is wrong. The moment of danger is when the water has already started leaving, but the boats have not yet fully stopped floating. That is where I believe we are. And I want to be direct about it. I do not think the great risk of 2026 is that the market suddenly learns a brand new truth. I think the risk is that a truth already underneath the surface becomes impossible to hide. The truth is that this system has grown used to more liquidity than its real underlying math deserves. The truth is that debt accumulated in an age of easy money is now being carried in a world where money is not easy. The truth is that people still price many assets as if the old regime is one comforting policy pivot away from returning. And the truth is that a great many investors still believe the Federal Reserve can save them the way it saved them before, without paying a much higher price than most portfolios are prepared to absorb. I do not believe that anymore. And I want to explain why. I grew up in markets when men still respected arithmetic more than headlines. Not because headlines did not matter, because arithmetic always collected in the end. I have watched manias, panics, policy rescues, recessions, and the full parade of human overconfidence, dressed up as innovation. The script changes, the actors change. The mathematics does not. Every genuine market break begins the same way. First, people stop respecting cash flow. Then they stop respecting debt. Then they stop respecting liquidity. Then the market punishes them in that order. The current cycle has all 3 ingredients. Cash flow is being priced as if cheap capital can always rescue a stretched business. Debt is being carried as if refinancing risk is some distant technical inconvenience. And liquidity is being assumed, not verified. That is the part I think most people are blind to. They think liquidity is there because prices are still high. That is backwards. Prices are still high because the market has not fully admitted how much liquidity has already been drained. That is a crucial distinction. I want to give you the central diagnosis as clearly as I can. The 2026 liquidity trap is not a dramatic moment that begins on the day television realizes it exists. It is a slow suffocation that starts while everything still looks investable. It is the process through which funding keeps leaving the system, rates stay high enough to stress every debt, heavy balance sheet, and the very institutions people rely on to provide relief are themselves constrained by the consequences of earlier relief. That is what makes this cycle harder than most people think. In 2008, the Fed could flood the room. In 2020, the Fed could flood the room even faster. This time, the room is already soaked with debt. Flooding it again may save one problem while making another impossible to control. That is the trap. The first mechanism I want to name is the debt rent. A lot of people hear that the United States owes around $38 trillion and they shrug because the number is too large to feel. I do not shrug. I ask a simpler question. How much rent is the country paying just to carry the promise? The answer now is about $1.1 trillion a year in interest alone. Not building anything, not inventing anything, not educating anyone, not defending anything. Rent. That is already more than the defense budget. And that figure is based on the blended cost of debt, not on what fresh money costs. Now, fresh money costs more. So each time old cheap debt rolls into new expensive debt, the rent rises. That is not a political talking point. That is a compounding machine. And a compounding machine that serves only past promises begins crowding out the future. That is when debt stops being an accounting issue and becomes a liquidity issue. Because the government has only so many ways to feed that rent. It can borrow more, it can tax more, it can cut. Or it can rely on monetary softness to make the burden feel more manageable in real terms. All 4 paths are painful, none are clean, and once the market sees that the debt must increasingly be managed politically rather than solved economically, the trust premium that used to shelter the system begins to erode. That erosion shows up first in funding. The second mechanism is what I call the Treasury vacuum. For a while, the system was given a strange gift. The Treasury could drain its own cash balance and effectively support liquidity even while rates were rising. That created a false calm. It let people believe the market had somehow become immune to tighter money. It had not become immune. It had been temporarily buffered. That buffer is now largely gone, which means the government has to go back into the open market and borrow in earnest. Every new Treasury auction is not just financing the state, it is competing for liquidity. Every dollar that goes into funding the government's deficit is a dollar, not simultaneously bidding up something else. This is what people fail to grasp. Liquidity is not merely a mood, it is finite. And when Treasury issuance accelerates in a system already carrying too much debt, the government begins acting like an industrial pump sucking water out of the harbor, not because it intends to break markets, because it must fund itself. That is why I say the crisis has already started. The water has already begun leaving. Most people simply do not watch the water. They watch the reflections on top of it. Now let me explain the three stages of the trap the way I see them. The first stage is the mirage. This is the phase where the market learns all the wrong lessons, rates rise, and yet prices do not fully break. Liquidity should be tighter, and yet indices still look resilient. Commentators conclude the system is stronger than feared. They say the economy can handle higher rates. They say the market climbed the wall of worry. They say cash was a mistake. That is how the mirage works. It flatters people for learning the wrong thing. It teaches them that the old playbook of endless liquidity will probably return, because even when liquidity was tightening, prices refused to fully confess weakness. That is not strength, that is lag. The second stage is the quiet squeeze. This is where we are now. The headline indices can still look healthy enough to calm the crowd, but underneath the surface the strain becomes visible if you know where to look. Breadth deteriorates. Smaller companies stop behaving like a healthy bull market should let them behave. Financing gets more selective, deal flow weakens. Bids in secondary markets feel thinner than the headlines suggest. The weakest structures start cracking first because they need the most water under them to remain upright. Zombie companies, fragile real estate vehicles, regional banks with ugly exposures, speculative growth names priced for a world of easy refinancing. These are not separate stories. They are the same story told in different costumes. They all need more liquidity than the system is increasingly willing to provide. This phase is dangerous precisely because it does not feel dramatic enough. It gives people time to rationalize. It tells them there is still time. It lets them keep postponing the uncomfortable rebalance they know they should have made 6 months earlier. Then comes the third stage, the break. The break begins the moment a hidden strain becomes too public to call isolated. A bank stumbles, a private fund gates redemptions, a credit market that looks sleepy suddenly refuses to clear the way it used to. A high-profile refinancing gets pulled. A regional institution that everyone assumed would muddle through suddenly becomes a symbol. The specifics matter less than the sequence. Once 2 or 3 of those moments cluster, the market stops treating each one as an exception and starts recognizing them as symptoms. That is when correlations change. That is when people who thought they were diversified realize they merely own several versions of the same dependency. That is when margin calls stop being stories about somebody else. That is when price falls, not because a chart broke, but because liquidity left. And when liquidity leaves, the market no longer debates fair value. It clears for cash. That is what a break is. A forced auction in a room with too few patient buyers. Now, I want to address the comforting objection because I know it is sitting in the back of your mind. The Fed always saves the market. Yes, historically, that has often been true enough to make many people intellectually lazy. The Fed cut in 1987. The Fed cut after the dot-com damage. The Fed cut and printed in 2008. The Fed flooded the world in 2020, so people learned the wrong moral from the right historical memory. They remembered the rescue. They forgot the conditions that made the rescue possible. This time, the Fed is trapped between two ugly masters. If it stays tight, the debt, rent, and refinancing pressure keeps squeezing the system until something breaks more openly. If it eases too hard, it risks reigniting inflation, weakening the dollar, and confirming to every serious observer that monetary discipline has been subordinated to debt management. That is why I call the current environment a trap rather than just a recession setup. There is no clean, heroic move, only trade-offs. and markets do not react kindly when the authority they depend on no longer has a clean playbook. This is also why I do not want to hear the phrase new paradigm from anyone who wishes to keep my attention. I heard it in other forms in 1999. I heard it in other forms in 2007. I heard it whenever a group of smart people became so intoxicated by what had recently worked that they started explaining away the timeless relationship between price, funding, leverage, and survival. Every era thinks it has invented a reason fundamentals no longer matter. Then fundamentals collect. Always the modern version of the fantasy is that the market can remain concentrated, expensive, liquidity, dependent, and policy dependent indefinitely because artificial intelligence, productivity, or innovation will carry it through any valuation and any rate regime. I am not anti-innovation. I am anti. Arithmetic denial. A great technology can still be a poor investment if you pay a foolish multiple and fund it in a system where liquidity is being drained. A wonderful business can still disappoint you if the discount rate and the macro structure change against it. Price matters, funding matters, and liquidity matters most when everybody has forgotten to respect it. That is why my own playbook is built around 5 buckets. Not because 5 is a holy number, because each bucket does a different job. The first bucket is cash and treasury bills, 35%. That is not because I suddenly fell in love with yield. It is because I respect optionality. Cash is not trash when everyone else will need it more than you do. Cash is the right to act while others are negotiating with their own fear. Cash is the ability to buy quality at an ugly price without first becoming a forced seller of something else. In a late cycle world, cash is not cowardice, it is stored decisiveness. The second bucket is the short book, 25%. That includes direct shorts and put exposure against exactly the areas I think are most dependent on liquidity conditions the market has taken for granted. Zombie businesses, commercial real estate structures, still pretending old valuations matter. Regional banks sitting on ugly exposures. The public has not fully repriced. The NASDAQ itself, because when the room loses water, the longest duration, most crowded, most narratively loved assets usually learn humility first. I do not short because I enjoy pessimism. I short because when the arithmetic is bad enough, negative exposure becomes a form of honesty. The third bucket is gold and precious metals, 20%. Not because I expect a cartoonish doomsday tomorrow, but because if the Fed eventually chooses the easier inflationary path to relieve the debt burden, I want ownership in something nobody can print and nobody can politically redefine on a Sunday night press conference. I prefer the miners rather than only the metal because operating leverage matters when the metal finally re-rates. I also want silver exposure because silver is a monetary metal wearing an industrial demand engine beneath it. The fourth bucket is energy, 10% oil, gas, and uranium exposure. Why? Because the one thing central bankers cannot manufacture is a barrel of oil or a molecule of natural gas. If policy turns softer while supply remains structurally constrained, energy becomes one of the clearest ways to own the inflation that follows the attempted rescue. The fifth bucket is defensive staples, 10%. The businesses people still buy from when budgets get tight. Soap, toothpaste, basic household goods, essential foods, things with pricing power because ordinary life keeps needing them even when markets behave like lunatics. That is not a glamorous portfolio. It is not meant to be. It is a portfolio designed to survive the quiet squeeze, exploit the break, and then transition into offense, once the Fed is forced to admit the damage more openly. Now let me tell you the 3 signals I care about most, because I do not believe in pretending I know the date of the break. I do believe in thresholds. The first is the 10-year Treasury yield. If it pushes above 5% and holds there, you are no longer looking at ordinary discomfort. You are looking at the bond market demanding a risk premium from the sovereign itself in a way that changes everything about the debt rent. That is a red flare. The second is the regional bank complex. I watch the regional bank ETF because when it loses enough altitude, it is telling you that the credit structure underneath commercial real estate, local lending, and balance. Sheet confidence is becoming unstable. A sharp enough break there is not a side story. It is a pressure gauge. The third is credit spreads, not television spreads. If the spread between junk and investment grade debt widens meaningfully enough, it tells you financing itself is freezing. And when financing freezes, the equity market is usually just a little late to the truth. The market always loves the surface longer than the plumbing deserves. That is why these signals matter. They are not prophecies. They are confirmation that the harbor has lost enough depth that the boats can no longer fake stability. Once two of these signals are flashing together, I become much more aggressive with the short exposure. That is phase 2 of my own playbook. I shift from quiet defense to active exploitation. Why? Because great crashes do not pay the most to the people who became worried at the bottom. They pay the most to the people who arrived with preparation before fear became consensus. Then comes the hardest part psychologically, the covering phase, when the world feels like it is ending, when panic is loud, when good assets are being sold next to bad ones because the market is clearing for liquidity rather than judgment. That is when a serious investor must begin doing the opposite of what his nervous system wants. He must cover some shorts, he must step toward quality. He must start buying the kinds of businesses he admired when they were too expensive and could not justify owning, because suddenly the market is offering them at prices that only exist when people are acting from pain rather than patience. That is how wealth compounds across full cycles, not by squeezing every last inch out of the good times, by surviving the bad times intact enough to buy the great assets that panic shakes loose. This is why I am so severe about one particular mistake. Do not marry your positions. Do not turn a thesis into your personality. If the facts change, the portfolio changes. That is not weakness. That is respect for evidence. I learned this painfully years ago when I was right about a bubble and wrong about its timing. The market kept going longer than my pride wanted it to, so I stepped aside. That saved me. Later, when the break really came, I could re-enter from strength rather than from wounded ego. That lesson matters now. You can be right about the destination and destroyed by the path. If you let your analytical ego outrank your capital. Never let that happen. Your ego does not need protection. Your capital does. That is the contract. If the Fed genuinely restarts large-scale balance sheet expansion, if it moves from talk to action, I will respond. If the signals worsen, I will respond. If the market begins offering great businesses at absurd discounts, I will respond. Response is the point, not prophecy. The people who get hurt in major breaks are not usually the people who studied the warning signs and got one detail wrong. They are the people who never built a playbook at all. They trusted comfort. They trusted the surface. They trusted the old rescue story without updating for the debt, the inflation, and the funding strain of the new cycle. That is what I want you to avoid. If you take nothing else from this, take this. The liquidity trap is not coming. It is already operating. The water is already leaving the harbor. The market's calm surface is not evidence of depth. It is evidence of delay. And delay is the last gift the system gives you before it demands payment. So ask yourself honestly which 5% you want to belong to. The 5% who understand the trap while it still looks manageable, or the 95% who will call the break shocking only because they chose not to study the depth beneath their own boat. That is the threshold. That is the choice. And if you respect it now, you may still be one of the people buying when everybody else is only capable of explaining what they should have done.